Have you been reading a lot of headlines and you think the housing market's headed for a crash? Well, let's take a closer look. Hi, I'm Nick with the Iannitti Group. I just want to come at you with a real quick housing update for November. Going to start off right here basically with some mortgage rates, right? And where we're going on with that. So we know that, the US, the 30-year fixed mortgage rate has increased 3.83%. That's the biggest year-to-date increase in rates in over 50 years. Kind of looks something like this, okay? Essentially, rates have doubled since the beginning of the year. That's huge, right? While mortgage rates are expected to continue to drift higher over the coming months, though, much of the I'll get it out rapid increase in rates is likely behind us, so we think, right? But what's really happening, what it's causing is a lot of decreased buyer demand. We continue to see buyer demand decreasing all the way across the country. And this is just direct relation to affordability, right? Remember, for every increase in a 1 percentage point of mortgage, that decreases a buyer's purchasing power by 10%. Okay, so Wall Street Journal always does a survey basically on looking at the probability of a recession coming. This latest one in October, basically 63% of economists think that we're probably headed for a recession with our current economy. The reason I bring it up is because, if you follow me, you've seen this slide before. Recessions do not mean falling prices, right? If we look at recessions, we look at home pricing over the past 6 recessions, realize, okay, 2008 was the anomaly. That was actually a recession that was specifically brought on by the housing sector. But again, typically, historically, recessions and home prices are not directly correlated. What is, though, are mortgage rates. Typically, when we see recessions, we do see mortgage rates coming down. So if we do wind up in a recession here next year, you could expect that these mortgage rates will actually come down, which will bring buyers back in, coupled with our incredibly low inventory, and we'll see the market start to heat back up again. Okay, so what about foreclosures? I didn't talk about this last month, so I just wanted to bring it up real quick with you because we saw an uptick and I want to explain it. I want to provide you a little bit of context, right? We know from the Adams survey 2021, foreclosures are incredibly low. Actually, when we look at all distressed property sales, this is as of September, it's only about 2% of all sales in the entire country, okay? Adam data basically said here, this was basically second quarter of 2022, only 0.4% of all mortgages were actually facing foreclosure, okay? And of that, basically 91% of them had some type of equity in the bank, which can help them basically stave off that foreclosure. Okay, so second quarter though, I thought this was pretty interesting. Marina Marsh, MBA. Second quarter in a row, the mortgage delinquency rate fell to its lowest level since MBA's survey began in 1979, declining to 3.45%. Foreclosure starts and loans and the procedures of foreclosures also dropped in the third quarter to levels further below historic averages, right? So what does that mean? People say, well, I thought I saw in the news that foreclosures have ticked up. Well, they have. They've ticked up from 2021, but keep in mind that we had a foreclosure moratorium, right? People were not able to foreclose, and people were predicting as soon as that went away, we were going to see this huge wave. Well, we haven't, right? It's now gone away, and here in 2022, things have ticked up, which is true. But if you look at this for scale, for perspective, we are still incredibly low. There's not enough foreclosures out there to really have an impact on the market either way, okay? So what are experts saying about home prices? Well, a little bit of a mixed bag, right? Some of them are basically calling for depreciation next year. Some are calling for appreciation. In one of my previous videos, I think it was 2 months ago, I kind of did a little bit more of a deep dive into this. Realize this is going to be location specific. So if you want more information on that, check out one of my local market updates. I'll be doing that right after this video, okay? So it really depends on some markets, we're gonna see some depreciation. Some markets, we're gonna see appreciation. Some markets, we're probably gonna see that are just gonna be kind of stagnant, kind of flat. And some of that may be drawn on some people that have a very low mortgage rate. They're not really enticed to move, okay, and take on a new mortgage at a much higher rate. So we're starting to see some of that kind of stagnant, right? When we're looking at big banks, Goldman Sachs, Wells Fargo, Moody's, Morgan Stanley, they're calling for deeper depreciation here in 2023. Just keep in mind though, Goldman Sachs, Moody's, Morgan Stanley, these banks really deal with people more on like an industrial level, right? People who are building subdivisions and high rises, things like that. They don't really typically deal in real single family mortgages, kind of like Wells Fargo does. But when we look at Wells Fargo, I thought this was interesting to note. Yeah, they're calling for 5.5% depreciation next year, but they're calling for a recovery in 2024, things to bounce back. Okay. Keep in mind when we look in 2008, the Great Recession, we had 5 consecutive years of home depreciation. No one is forecasting that right now. Okay. So as far as the crash, it's just not looking like that's going to happen. But I do want to talk about some of these headlines that are out here, right? Because I've said it previously in these videos that a lot of these headlines, they do a much better job of terrifying than they do actually clarifying what's going on, right? So if you look at this tweet from Diana Olick here, CNBC, they came out, homeowners have lost $1.5 trillion in equity since May, right? According to the Black Knight study. That's a true statement, but you have to dig into that Black Knight study to get some context, okay? For example, that $1.5 trillion in equity loss constitutes about $11,000 per household. So if your house has made tens of thousands of dollars, or in some cases, hundreds of thousands of dollars in appreciation over the past few years, is $11,000 that dire? No. But for more context, when you look at it this way, right, we're talking about tappable equity. So what that means is, remember that a lender won't let you take more than 80% of the value out of the home, right? Well, when we actually control for that, we're still about $400 million above where we were last year, right? So is that, yes, we've lost 1.5 trillion in equity. I'm not saying that's a little thing. I'm saying we need to keep that in context, okay? Okay, so homeowners have very high levels of tappable home equity today, providing a cushion to withstand potential price declines, but also preventing housing distress from turning into a foreclosure. I already spoke about this, right? The result will likely be foreclosure trickle, then a tsunami, and that's actually what we're seeing, okay? Another one though, household debt soars at the fastest pace in 15 years as credit card usage surges, right? Well, that's a true statement, but when you put it into context, when you look at the actual balances where we're at right now, it's basically right where we were, 2019 Q3 before the pandemic, right? So that big increase that they're talking about, that's this right here that you're looking at. Okay, well, we know during the pandemic, lots of people kind of put a freeze on credit card spending, right? We know they weren't traveling, they weren't making any huge purchases unless they were basically improving their home. But other than that, their credit card usage was a little bit different in that, 2020 through to 2021, right? And then actually, once we started to realize, okay, this isn't going to be the end of the world, things started to snap back, right? So you need to keep that in mind. And actually, though the delinquency rates are rising, they remain low by historical standards and suggest consumers are managing their finances through this period of increasing prices. Okay. We also saw that too with the Black Friday numbers that just came out. They were actually like historic spending numbers. So people, shoppers are still out there. People are still spending money. But what we really want to look at is the mortgage debt to income ratio, right? This is what we're talking about when it comes to, are we going to see distressed stuff or the market really heading towards a crash? And when you look at it, we're at 3.9% today. That's lower than we were all the way back in the 1980s. Okay, so we're still in very good shape. So I just want to basically give you a little bit of context there. So anyway, if you have questions about, what do these numbers mean? What's going on? Is this a good time to buy or sell? Look, if you're renting right now, this is still a great time to buy a home. I understand the rates are a little bit higher and they may come down. You may have a chance to refinance in a couple of years, but it's still better than the alternative rents because we know rents are increasing faster than the mortgage rates are. Okay. Is this a good time to sell? Well, keep in mind that we're still in a seller's market. We still have an incredibly low level of inventory. Okay. Still less than 3 months of inventory nationwide. So anyway, like I said, if you have questions, just reach out. More than happy to answer those questions. Thanks so much for tuning in. And remember, who you choose to negotiate for you absolutely matters.